Welcome back. Markets are in positive territory very early into the trading day this morning, but the narrative continues to be one of trade tariff tensions between Canada and the U.S., indeed between the U.S. and many of its trading partners. Let's check in with Greg Taylor. Greg is Chief Investment Officer at Purpose Investments for his take on some of this. Greg, thanks a lot for joining us. What is your view on this increasingly tense tariff situation between Canada and the U.S.? What does it portend for the Canadian economy? And separately, what does it mean for stock market investors, including those invested in the Canadian market?
Yeah, thanks, Paul. And that's a good question, because this is really the point where you do find that the economy and the stock market aren't the same thing, because yes, the threat of tariffs are really bad for the Canadian economy and could have an impact. And we're definitely seeing that have an impact on the Canadian dollar and how it's trading versus the US dollar. But the Canadian stock market has been doing okay and is looking through this. And it's really a result that, the economy and the stock market aren't the same thing. And the sectors we're exposed to in the market are actually ones that might do okay in this world. So I think it's going to be something that's going to cause volatility. We came into this year expecting volatility with Trump back in office, and we're certainly getting it, but it so far has been an upward bias, and markets are looking through the tariff threat so far.
What would be the sectors of the Canadian stock market that would suffer under a tariff war situation? Auto parts comes to mind.
Yeah, absolutely. Anything that has manufacturing in Canada is going to hurt. And that's really why we're seeing Magna and Linamar and Bombardier, companies like that, underperforming. And for rightly so, because they're definitely going to be in the gun sights of this. I think the resource stocks, though, there's going to be lots to talk about them. We've already saw that the energy price and oil might be excluded from the tariffs, or they set a discounted rate. And that's just really looking at reality that at the end of the day, the Americans need our fertilizer, they need our uranium, they need our lumber, they need the oil. And as much as they can talk tough and say that they're going to put tariffs on this, I think in reality, that's inflationary, and they do not want inflation back, especially after the CPI print yesterday. So I think it's really the manufacturing stocks that will be in the gun sights, but I think right now the market's looking through this.
What kind of resolution do you see on tariffs and energy? You say that, and many people do say that tariffs on Canadian energy are going to materialize pretty quickly at the gasoline pumps in the United States, which is something no administration wants. What do you see coming there? A carve out for Canadian energy?
Well, I think there has to be a carve out, because if you look at just the way the North American economy is set up, basically all the Midwest and Chicago is basically fully funded by Canadian energy. And you can't just put a tariff on that, because it's going to be massively inflationary for that part of the economy. And that's really, those are red states that are very important to Trump. So you have to think that's going to be excluded. And then you look at the refiners on the Gulf, and they're all set up to do Canadian heavy oil and use that. And that's something that they are talking about, again, that this can't happen. So I think right now the market's looking through this, thinking this is all bluster and trying to get back to the negotiating table. And if you look back to how Trump negotiated in his first term, I think we're seeing a bit of a repeat right now.
What is your view then, with that in the background, of the TSX energy sector, the oil and gas producers?
Well, I think the energy sector has really been choppy, because more is looking at global growth more than anything else. And we know that China's suffered. There hasn't been as much economic recovery post-COVID in Asia. And I think that's really what's been holding back the energy stocks of late. That being said, though, things are starting to pick up, and we're starting to see Europe do a lot better. So as the global growth story comes back, if China does do a round of stimulus, which we're expecting into March, that could be a nice thing to kickstart the Canadian energy stocks. And at the end of the day, these companies, again, are way better run than they were in the past. They're returning a lot more capital to shareholders, and right now they're a good valuation. So the stocks haven't done too much of late, but it probably is setting up for a decent return in the near term.
What about the forestry sector, the lumber makers? We're going to talk later in this program with another guest on the results from West Fraser Timber. But what would be your outlook there? And that obviously, softwood lumber, we know, has been a flashpoint, a point of tension between the two countries for years.
Yeah, it absolutely has been. And it's been something that we've been negotiating, it seems like, for 10 plus 20 years. And I don't know if this is going to be any different in the next little bit. The big thing going forward, though, is we're looking at a U.S. economy that really has to rebuild L.A. And that's a lot of housing, then, houses that to rebuild. And they're going to need lumber for this. So as much as they can talk tough, they do need this lumber. And I think that's going to be the deciding factor to hopefully get a good resolution that works for everyone.
That's Greg Taylor. He's Chief Investment Officer at